Hi. Well, today what I want to talk about in this video, which is for digital agencies and potential tax issues. This is not really a tax opportunity, but a tax issue to watch out for, and that is the GILTI tax, the Global Intangible Low Taxed Income tax, which they created the clever acronym, the GILTI tax. And your digital agency might have this issue or need to deal with this if you have what's called a controlled foreign corporation, which is basically a subsidiary company in a foreign country, a foreign jurisdiction. And why would a digital agency have such a thing? Well, a lot of digital agencies have development teams which they have in foreign jurisdictions. They could be software development, doing like programming and coding, or they could actually be content development teams that do editing and video processing and things of that nature. But whatever it is, you may have teams of people that are talented, skilled people which are situated in foreign jurisdictions, and the way you've organized that is you actually have a subsidiary of your company that operates in that foreign jurisdiction that you own, and that for US tax purposes, that subsidiary may be considered a controlled foreign corporation. If that fits your facts, if that's your situation, then you probably would be subject to the GILTI tax. Now, I did another video on the topic of FDII, Foreign Derived Intangible Income Deduction, and that's when you are a US company, potentially a digital agency that is selling their services or their digital products to foreign companies or to foreign people. And that on that side, it's a benefit. But some of the concepts are the same. The same concept for FDII applies in the GILTI tax arena, which is this idea, this concept that was passed in both these laws, that you should be able to generate a 10% return on essentially your fixed assets, and that's not intangible income, but that any income above that 10% return on your essentially what's your fixed assets would be considered intangible income. And so that concept is found in the GILTI tax as well. The idea is that if you're controlled foreign corporation, your subsidiary company is generating income, and you think about it in the way I described it, if you're a digital agency and essentially you have cost centers, development teams parked in lower cost foreign jurisdictions, then it's likely that most of the income from that foreign subsidiary is considered intangible income. Because what's probably happening is that foreign development team is developing content or writing code on behalf of your US company, your US business. And you set up a transfer pricing arrangement where you're paying a fair price, you're paying the market price for those services in that foreign country, and then in that foreign country, they have revenue for the fee that you pay, and they have the expenses of people's payroll and so on, and they have some amount of profit that's subject to tax in that foreign country. And now under the new US tax system for dealing with these kind of foreign transactions in these foreign structures, that income you have in the foreign country is probably all considered intangible income, or mostly all, because there's not a lot of fixed assets to do that kind of work, right? It's mostly the value of the work, and the fee mostly relates to people's time and effort. It's a service. And so in that regard, that income is probably intangible income, and then it would be subject to this GILTI tax regime. So what happens is that income that is considered to be GILTI income above and beyond that 10% return on essentially your fixed assets, is then taxed on your US tax return and is treated as income subject to US tax. Now, there's incredible benefits to being structured as a C corporation in the US that owns that foreign subsidiary, because if the controlled foreign corporation is owned by a C corporation, then currently there's a 50% deduction against the GILTI income that reduces the amount of tax from what would have been 21% down to half of 21%, which I can't do math in my head, but what is that, 10.5, right? So we've got a much lower tax rate on that GILTI income because of the 50% deduction. But even more likely is that you, as the C corporation that owns that controlled foreign corporation, you may not pay tax on that GILTI income at all, because if you are a C corporation business that owns that foreign subsidiary, you get to take a foreign tax credit against your GILTI income. So you get to say, well, if I paid tax in that foreign jurisdiction and it was greater than 11%, then I'm going to be able to credit that tax against my U.S. tax on that same income, and that's going to wipe out the U.S. tax. So that's why it's called the global intangible low taxed income issue, right? Because the only way you're really going to have U.S. tax on this issue currently is if the tax rate in the foreign jurisdiction is less than 11%. Then you potentially have a small U.S. tax hit on this if you're structured so that your business in the U.S. is a C corporation that owns the foreign subsidiary. There are lots of complications if it's not structured that way. So if it turns out that your U.S. business is a flow-through entity or an individual that owns the controlled foreign corporation, then you don't get this 50% deduction and you don't get to apply the foreign tax credit. So it very well could be that your individual owner of the controlled foreign corporation, like a sole proprietor that's a digital agency, that person also happens to own a foreign company that does development work for them. In that scenario, the GILTI income will just hit their U.S. tax return, their personal U.S. tax return, and they will pay U.S. income. They'll pay U.S. income tax on it, just like the rest of their income, and they don't get the deduction, they don't get the foreign tax credit. So for that reason, we now would advise that if you have international operations, if you have foreign subsidiaries, if your digital agency is working globally, then it may be a good idea for your U.S. company to be structured as a C corporation. There is such a thing as a section. There is such a thing as an election. I won't throw code sections at you here, but there is an election to treat an individual owner of a controlled foreign corporation as if they are a C corporation with regard to their income, including their GILTI income, and that gets to be fairly complicated. It's questionable whether that actually results in a better tax situation, but you have to run a bunch of spreadsheets to kind of figure it out. I find it to be not the best band-aid for that situation. So I think in most cases it's probably better to actually structure your U.S. business as being a C corporation. But as anything with accounting and tax matters, the facts can be different business by business, and it really depends on the situation how you deal with this. So as with any of my videos, the point of this video is making you aware of the issue, making sure that you've thought about it, done some analysis on your own or with an advisor to consider how you're going to deal with it. That's the point. If you think you have a GILTI tax issue, take a look at it. Okay, well that's it for now, and I will see you in a future video to continue talking about digital tax strategies, digital agency tax strategies. Take care.